We begin today taking a look at the big banks and whether or not they are still too big to fail. Massachusetts Senator Elizabeth Warren yesterday grilled Federal Reserve Chairman Ben Bernanke.
Excuse me, though, Mr. Chairman, you did not wipe out the shareholders of the largest financial institutions, did you? The big banks?
Because we didn't have the tools. Now we could.
Well,
now we have the tools.
$83 billion says that whatever you're saying, Mr. Chairman, $83 billion says that there really will be a bailout for the largest financial institutions if they fail.
No, that's the expectation of markets, but that doesn't mean that we have to do it.
Well, Warren also asked if the banks are going to pay taxpayers back the big chunk of money it gets every year. She's citing a study, a Bloomberg study, that says a handful of the nation's biggest banks get $83 billion in subsidies annually. So why are the banks getting a break? To discuss, Anthony Randazzo, Director of Economic Research at the Reason Foundation, joins me from New York. Welcome, Anthony. So when are we going to get rid of too big to fail? That's the question she's asking. Why is it so hard to answer?
Well, the Dodd-Frank Act explicitly tells a regulatory body called the Federal, it's called FSOC, but it's a Federal Stability Oversight Committee, to identify banks that are too big to fail. And so this agency, FSOC, has named several companies that are large financial institutions, effectively saying, if these companies go under, we have to do something about them. Now, Ben Bernanke says, well, the markets expect that we'll bail these companies out, but just like with Fannie Mae and Freddie Mac before and during the lead up to the financial crisis, everybody's expecting the government to bail out banks if they get in trouble because the belief in Washington is that we have to maintain stability. Ben Bernanke's explicit mandate at the Fed is to maintain price stability. Washington is all about trying to create stability in the financial markets. There's no way that if Goldman Sachs or JP Morgan Chase were to go insolvent that they wouldn't be bailed out. So there's this expectation exists, and it was explicitly put in place by the Dodd-Frank Act.
Warren there, she cited this figure of $83 billion that a few banks get in subsidies, and this is taxpayer money. Would the banks be able to survive without being propped up by taxpayers?
Well, let's parse out this $83 billion number, because it might sound as if taxpayers are actually giving that in cash to the banks, and that's not exactly what's going on.
It's in the form of subsidies.
Right. Yeah. So it's an implied subsidy. So what that means is, and it's related to the way that banks borrow money. So if any one of your viewers or yourself were to go get a loan, you're going to pay an interest rate depending on how good your credit score is. Now, large banks, because the market thinks that they're too big to fail, that they'll be bailed out, are effectively looked at as like very good credit risks. If you loan money to them, you're probably going to get it back because that bank is going to be bailed out if they get into trouble. So you can lend money to large institutions at a lower rate than smaller institutions. So these large institutions get some kind of benefit. We don't know exactly what that is, and there's all sorts of estimates. And the Bloomberg study cites an academic paper that suggests that they can borrow at 0.8% better rates than small banks. And if that number's correct, then that means that, in effect, taxpayers are offering an insurance program to banks every year that they should be getting $83 billion in premiums on that they're not getting. Okay. So that's where that number is coming from. If the subsidy is something different, then that number could be lower or higher. But the other way to think about it is, if the taxpayers are offering this too big to fail insurance program like life insurance, if that exists, the banks should be paying for that insurance, and they're not.
And Bernanke did argue that he argued against that $83 billion. He questioned how accurate that figure was. But either way you look at it, it's the big banks that are getting some kind of a kickback. They are getting, in relation to the small banks, they are getting rewarded. They are getting a kickback. So I want to ask you, the argument that you hear time and time again is that shutting down these banks would be disastrous for the economy. And of course, we saw this situation back in 2008, and the taxpayers foot the bill. They bailed out these banks. Has anything changed? Have any policies been implemented to make sure that we don't have to do that as taxpayers ever again?
The unfortunate thing is that since the financial crisis, the large banks have only gotten bigger. The fact that we did bail them out enabled the top 10 banks to essentially leverage that cash to position themselves and take even greater market share. So now the large banks are even bigger. So if in 2008 the banks were too big to fail and Washington was afraid, well then certainly if something happens again, it's definitely the case that the government will bail out Wall Street. Ben Bernanke was trying to argue, well, we don't really know if that's going to happen. That definitely is going to be the case. But even he admitted that the big banks have an advantage. You can't deny it. If you just look at the rates that the banks borrow at, the interest rates that they pay to borrow money, they're lower than smaller institutions. That implies a subsidy. Where is that subsidy coming from? It's coming from the market expecting that they will be bailed out. Nothing has changed. They've only gotten bigger. So it's a fair assumption by the market that, and if that's going to be the case, if we are going to explicitly have a too big to fail system, then the banks should pay for that insurance.
All right, yeah, so it looks like too big to fail is still a phrase that's going to be sticking around. Appreciate you coming on the show, Anthony. That was Anthony Randazzo, Director of Economic Research at the Reason Foundation.